This is a very good example for the short opportunity using the New York Open breaking out strategy. Right after the open, we can see their consecutive bear bars leading to the downside. 1, 2, 3, 4. And then each bar is getting larger, especially the second bar is larger than any of the bars on the left. So this is a typical breaking out pattern. And the reason it's breaking out is also because previously the market is consolidating. It is not going anywhere. So it could go down or it could go up, either way. So in this example, it is breaking out to the downside. So we need to prepare for a short opportunity. Second, that we trade only one direction, the same direction as what the market is breaking out right after the open. So in this case, it is breaking out to the downside. We only short in the very beginning of the market here. However, if the market reverses too much or even it goes back up, this is not the strategy for New York Open breakout strategy, so don't trade short, and then there could be another setup. The third thing for the New York Open breakout strategy is trade only for the 1, 2, 3 legs, either direction, up or down. So in this case, you can see the breakout is the first leg. Pull back a little bit, and then we have the second leg here, and then we have the third leg. After the third leg, do not trade. It is not the strategy. It could be another setup. You could trade another setup, but it is not the open breakout strategy anymore. So maximum 3 legs. And then the second leg has higher probability than the third leg. Sometimes there's no third leg. That's possible, so you need to watch out. Fourth, you want to scalp rather than swing, because for this strategy to work is that we assume that the market will move very quickly. We just take the volatility in the very beginning of the market open, and then that's done. Do not wait until the end of the day. How do we scalp for this example? First, we have the breakout and then pullback. After the pullback, we wait for the signal bar. This bear bar can serve as a very good signal bar because it's a trend bar. Its body is larger than 60% of the whole candlestick. That's why after this bar finishes, we want to enter the market, and the bottom of this candlestick will become your break-even level. Right after you enter the trade, you do not want to put your risk to the top of the pullback right away. Instead, you want to give it a bit more room. You can put at the top of the breakout. That is because the market could pull back. This is one time, and then it can be another second time or third time before it goes down. So that's why you want to wait for the market to go down and then put your actual risk at the top of this pullback. And then after that, this is gonna be your risk. So this is the distance for your risk. And you want to measure down for 1 and 2 times of the risk, which could be your profit target. So in this case, if you're scalping, one rule is that you want to take profit between 1 and 2 times of risk. Do not go down even further. If further, that is not scalping. And from this example, you can see right after the market hits the 2 times of the risk, it reverses a lot here and then consolidating. That means others are using the same strategy to take profit, maximum 2 times of the risk. But how much do you want to take the profit between 1 time and 2 times of the risk? It depends on your strategy and your understanding of the market and your homework of the historical chart. As this strategy is to take profit quickly, so normally 1 time of the risk should be good enough because it's easy to get. And if you want to take more profit, rather than set your profit target too far, you can add your position in the very beginning. So if normally you trade 1 contract, you can think of increase your contract number to 2 to take more profit. So you're gonna get hit quicker than when you wait for the 2 times of the risk. You may ask, I do not see very clear the second leg because it's like a consolidating. That is true. Another way to look at this chart is we have the first leg going down, and then the market consolidates a little bit because there are bull bars, bear bars consecutively here. So that is a consolidation range. And then this leg down with consecutive bear bars can serve as the second leg. So it depends on how you understand the chart. There's a pattern that there's a breakout and then consolidate and then another breakout. That pattern for the consolidation range, it could be flat, and then in this case it's going down a little bit, or it can go upward a little bit as well. So if that's the case, you can also trade like normal, that based on this bear bar as the signal bar but trading down. But when you see the consolidation, you know that it could get into the other pattern like lag, consolidate and lag, rather than the traditional 1, 2, 3 legs down. If you treat this as a consolidation with 2 legs before it and after it, how do you take the profit? So you can use the measure move. The lag, consolidation and lag pattern is very good for measure move techniques. What you want to do is to measure the distance of the first leg from the top of the first breaking out bar to the bottom of the last breaking out bar, and then this is the distance. Measure exactly the same distance from the top of the last pullback here to the bottom, and then you can see if you are taking profit using the measure move, you're gonna exit here. More importantly is for you to understand different scenarios, different setups, different patterns, so when they comes, you know what to do.